An earnings surprise is a situation where a company reports profits that are significantly different from what analysts or investors were expecting. In simple words, it happens when the actual earnings per share come in either higher or lower than the market consensus forecast. Positive surprises usually push stock prices up, while negative surprises often send them down. The concept of earnings surprise became important in the 20th century as financial analysts and investment banks began publishing regular forecasts of corporate earnings. Investors started to treat these forecasts as benchmarks, so the difference between reported results and expectations became almost as important as the results themselves. This is why you often hear in the news not just what a company earned, but whether it beat or missed expectations. Here's how it works in practice. Suppose analysts expect company X to report earnings per share of $2. If the company actually reports $2.50, that is a positive earnings surprise of 50 cents, or 25% above expectations. If it reports $1.75, that is a negative surprise. These differences are usually expressed as percentages relative to the forecast, and traders react quickly once the numbers are released. The impact of an earnings surprise can be dramatic. A positive surprise may indicate that the company's business is stronger than analysts thought, boosting confidence and attracting new investors. A negative surprise may suggest weakness, mismanagement, or declining demand, causing the stock price to fall. Sometimes the reaction is even stronger than the numbers justify, because investor psychology plays a big role. A famous example occurred during the tech boom of the late 1990s and early 2000s, when internet companies often delivered huge positive surprises, fueling massive rallies. Conversely, during the financial crisis of 2008, many banks reported negative surprises, shocking markets and deepening the downturn. Earnings surprises are also closely linked to the concept of market efficiency. According to the efficient market hypothesis, all publicly available information should already be reflected in a stock's price. Therefore, only unexpected news, such as an earnings surprise, should move the price. This is why event studies often use earnings announcements as natural experiments to test how quickly and accurately markets react to new information. A curiosity is that companies sometimes try to manage expectations to engineer positive surprises. They may provide conservative guidance to analysts so that actual earnings come in slightly higher, producing a small positive surprise and pleasing investors. Critics argue that this game distorts transparency, but it remains a common practice. In conclusion, an earnings surprise is the gap between expected and actual profits reported by a company. It is one of the most important short-term drivers of stock prices, reflecting how markets constantly adjust to new information. Positive surprises delight investors, negative ones disappoint, and together they reveal the constant tug-of-war between expectations and reality in financial markets. Above, you can find more videos to keep learning about law. Remember to give us a like and subscribe.